Hi, everyone. Thanks for joining the show. This is Bill Fairman and Jonathan Davis. Oh, I can't touch him.
Yeah,
We're social
don't touch,
distancing. Sorry. Carolina Capital Management, and welcome to another episode of our market update. We got some great panelists today. Our URL is carolinahardmoney.com. If you have any questions, comments, we have a chat box over there. Please ask questions. We have we'll answer those if time is allotted. While you're there, please share, uh, subscribe, like, thumbs up, all that stuff. We're trying to give you some great information that is impactful and that is current. So let me introduce everyone. I'm going to start off with Fernando. I'm going to Angelucci. I can't believe I can't. My mind is so tiny. Anyway, so Fernando is with Titan Wealth Group. He's a general partner with them. And then I'm going to give him a couple of minutes to go through his business here in just a moment. We also have Chris Miles of Money Ripples. Smile. Glenn Stromberg of Stromberg Investments. Jacob Vanderslice of Van West Partners.
Hey, guys.
And Sean Casterline of Aegis Wealth Management.
Hey, guys. How are you?
I love your shirt. you bring style to the show. Fernando, you're new to the group. Welcome. Give me a little bit about your background and what space you're in. What's your focus?
Yeah, so a little bit about my background. I was born to two immigrants that came to the United States from Brazil. They came here kind of with the American dream, which is work hard, go to school, get a good job, and retire with a pension 40 years later. Obviously, that doesn't work anymore. So when I was 16, I actually read Rich Dad, Poor Dad. And from there, I knew I was going to become an entrepreneur and then eventually a real estate investor. So I've gone through everything. I've done the single family thing, the multifamily thing, flips, seller finance. I've done it all. The biggest issues I was having, because I'm based in Chicago with my rentals, were the tenant laws here are extremely favorable towards the tenant. So I was about 8 or 9 months into an eviction. And I said, there's got to be something easier out there that's much more passive than this. And that's when I stumbled across SelfStorage about 4 or 5 years ago. And ever since, I've been kind of going gangbusters. Last year, we closed on 8 self-storage facilities. I sold all of my multifamily buildings. I have 2 more single-family homes to sell, and I'll be completely out of all the other residential properties and now into self-storage.
Excellent. Well, I like the self-storage space. I used to finance those years ago, and I kept trying to poke holes in them. And the only hole I could poke in there is something that's not going to happen very often. So
right.
It's a good space to be in a down market and in an up market.
Right.
People are either downsizing or they buy more stuff than their house can hold, or they get emotionally attached to their $500 worth of junk and end up spending 3 years in storage, paying $150, $200 a month for it. Yep. And the reason I can joke about that is because I'm one of those. I have one. So I want to talk about some current numbers that have just come out. So today's unemployment, new unemployment claims, 5.25 million. If you add that up since this started, it's around 23 million total so far. Now, I think the good news in that is that a lot of this is going to be temporary furloughs. Yeah. These aren't people that are just going to lose their jobs completely. However, we all know that there's going to be a lot of businesses that aren't coming back from this, that they were maybe teetering or over leveraged at the time. And then with the way people are going to change how they do things, it's probably going to force a few people out of business too.
Absolutely, yeah.
The good news is because people change. There's other opportunities for different business, right? So you're going to see the Uber drivers that were carrying people are now going to be carrying food and groceries. So, I mean, there's still a place for them. It's just going to be a little bit different. One of the things that I saw today too was that new housing starts are down 22% from last month, and then they also had the builders. Now these are the home builders. The sentiment survey, and again, I always laugh about this because they're asking their feelings on something, not necessarily actual numbers. And the survey is, 1 is the worst and 100 is the best. They were at a 38 this month. So,
and prior it had been,
yeah, it had been in the upper 80s and 90s for the past few years. So their sentiment on future housing is not great. Building permits are down in most sectors except for multifamily. They've actually had a little bit of a surge in multifamily. I'm thinking that maybe there was a few commercial projects or mixed-use projects that they decided to build the multifamily part first because they know they can probably get those tenanted fairly easily.
much easier than the commercial side. Yeah.
So my question, and I'm going to start with Fernando since he's our special guest today. What is it that you're focusing on right now?
Yeah, so our business is a counter cyclical business. So we actually do really well in times of recession. For example, between 07 and 09, when the S&P dropped 22%, a survey of all the REITs in the real estate sector showed that self-storage only dropped about 3.5%. And when I talked to actual independent operators, they actually showed increases. And we're seeing that in across our portfolio. Our occupancies are up against historical numbers. Our defaults are trending at the same level as they have been for the last 6 months. So it's working really well for us. As far as what we're doing specifically on the tenant side of things or on the client side of things, we are, reaching out and we're making sure that they know how to apply for, if it's a small business, EIDL loans and the PPPs, which I think as of today have run out of money. And telling them that we'll work with them with some type of payment plan to defer payments or maybe even eat into some of the security deposits. On the acquisition side, we are going gangbusters. We've had almost a 25% increase in seller leads coming into the company over the last 8 weeks. And that also coincides with the average accepted offer across a facility dropping by roughly 10 to 15%. So we're aggressively making offers right now. And it seems a lot of, let's say, less sophisticated owners are looking to get liquid and are willing to take a pretty large discount in order to get cash in 30 or 45 days.
Nice. So do you have a larger percentage of your tenants, small businesses in these facilities, or is it fairly small piece of your self-storage?
Yeah, so our residential tenants account for between 65 to 70% of our tenant base. And then commercial tenants are about 15 to 20%. However, those commercial tenants, they represent a much larger income coming into the company because they're the ones that are renting out the larger units, the 10 by 30s, the 20 by 30s, and also have the contractor units that have electrical power, things like that. What we've noticed is that of our tenant base, the commercial guys haven't really had any types of defaults really yet. The residential folks, their defaults have been trending with the ratio to occupancy, and our occupancies are up. So we're not seeing really much increase in default across our facilities at the moment.
That's great. Well, the commercial people, I think, are going to be the type that are still considered essential businesses. So I think you'll be in pretty good shape for those. Chris, What are you focused on now?
Same thing as always, cash flow, right? I think I'm just beating the same stinking drum I've been beating for years, which is just it's time to prepare for the ups and the downs, right? And we're seeing that right now. Right now, with my investments, I've got a lot of different real estate with residential and things like that. They're doing fine. They're doing great. We'll see how that goes as time goes on, right? But for the most part, like everything's just pretty much going as planned. Even the two active things I do that I'm kind of part semi-retired, right? I'm doing things on consulting side, which obviously I'm getting more requests there because people are like, what the heck is going on, right? And then I get people also looking for safe harbor, which is the other side I do, where I do the whole infinite banking, whole life type of structuring and things like that. And people are looking for safe places to put money. So business-wise, has actually just been like normal, except now I just can't drive away from my house as often. It's just I'm stuck here. Like this is my prison. That's pretty much how it looks right now.
So, just out of curiosity, I know they tweaked the rules a little bit on a 401k, and I'm not sure if it has to do with borrowing money out of that 401k or actually taking so much of it in cash to pay bills with, and you're not having to pay the penalty. Are you familiar with that enough to talk about?
Yeah, yes to both. You can borrow from it and of course pay it back over the next 3 years. That's one option you have, and you avoid penalties and taxes there. Or you cash out, and you can actually do up to $100,000 for your IRAs, 401ks, whatever it might be. You can take if you've been affected by the virus in any way, shape, or form, if it's cut back your work hours, if it's affected things with real estate, your tenants, or whatever. Like if you've been somehow financially impacted by the virus, you can actually pull the money out up to $100,000, avoid the 10% penalty. You will still pay taxes, but they'll let you pay taxes over the next 3 years. So you're basically, the thing is you can avoid the penalty by either one, you borrow it and then you pay it back over a few years, or two, you end up paying the taxes over the next 3 years. So it's a great opportunity to get cash liquid right now, and I'd recommend it if it makes sense in your situation.
Well, my thought on that is if you take out up to $100,000, pay the tax on it, now you've got basically your own Roth that you can stick into one of those cash value policies and get your 4.5 guaranteed return on, which then you can borrow to invest in other things.
You definitely could. The great thing is with 401ks and IRAs, right, is that you have to, this is probably the bad thing about 401ks and IRAs, you have to pay taxes on them at some point. So right now, where we're already in a very low tax rate compared to the last several decades, this is like the best tax time right now. And so if you think about it, if you can avoid a 10% penalty, plus you can get at the lowest tax rate right now, this could be the perfect storm if you want to get access to some cash out of your mutual funds and get out of the market, especially as it's already recovered quite a bit. There's like this fake recovery that's going on. This is a great time to access those funds. And then, you can get them safe. You can get them working for you to create more income, which is really what's needed right now. Is you've got to have those streams of income coming in and have cash available for those opportunities that are coming up, because there are going to be plenty of them. There's opportunities now, and there'll be plenty of opportunities in the future too.
Excellent. Thank you, sir. Glenn, what are you focused on?
Well, I tell you what, we're just going after it. Business as usual. We picked up 4 properties this week. There's a ton of opportunity out there, and I, like I say, it's business as usual. Now on the tenant side, we property manage 400 doors. It's going very well. Collections are going very well so far. There's a small percentage of our people that have been hit that. We're like Fernando said, we're communicating on a daily basis with the people and making arrangements. And, we do expect there probably will be a couple of hiccups in May and June, especially if they keep this thing going. But we're letting them know all the sources where the government aid is, of course, unemployment and so forth. But collections have been very good, and it's business as usual, and we're hitting it hard. We think there's going to be great opportunity out there because a lot of people are frozen right now, and as you know, a lot of people are going to be getting out right now. So we built our business model for a down market, and we're ready to go.
Yeah, the opportunity is in fear right now, and I think the opportunity later is going to be as the market does I mean, listen, we're going to have a recession.
And there's no
no way
question
to
about
avoid
that.
that.
Yeah.
But I think there'll be opportunity later as the values drop down. Now you're able to capture kind of the fear of the unknown, being able to get some deals. But there will be real deals later because values are just going to be so much.
I agree.
Jacob, what are you focused on, bud?
Hey guys, well, you've got two self-storage guys on the panel this week. Fernando, great to see you. And I kind of echo your sentiment. We also pivoted into self-storage for the same reasons you did about 5 years ago. It's a great business. And like Chris mentioned, we're a lot more focused right now on cash flow than we are upside and equity multiple. We're trying to focus more on deals that have in-place revenue that is going to create a decent return without any value creation, NOI growth, net rental occupancy growth. So we're just trying to be cautious. We're trying to be responsible with our acquisitions. What was a good deal a couple months ago may not be a good deal today. So we're getting a lot more picky. And also, like Fernando, our inbound seller lead volume has gone up a fair amount really in the last couple of weeks. People are scared. They're running for the door. They're selling for prices they didn't used to sell for. So that's been a positive thing. And again, as Fernando mentioned, self-storage is pretty recession resistant, although this is a very unique type of recession we're entering here that we're already in, obviously. The speed that this kind of manifested itself is just obviously unprecedented, and we're not sure that's going to translate into our customer delinquencies, our net rental activity, our revenue. It's kind of a day-by-day thing. So we're trying to be cautious and just focus on deals with good in-place cash flow.
Thank you, sir. Sean, batting cleanup.
Yeah, man. Hitting the ball of the park. I think it's a really good panel. I mean, obviously, you guys don't need me to tell you this, but a lot of defensive investments, obviously, Tuscan Gardens were developing and acquiring senior living communities. We're obviously focused on keeping our residents safe first. And obviously, COVID-19 is more lethal to seniors than anyone else. And we went on lockdown in our communities about 7 or 8 weeks ago. So we're keeping our folks safe. It's hindered the business a little bit because we can't do tours, but we are still taking residents, and that's one of the nice things about senior living. It's a needs-driven industry. So when you need the care, you need it. So again, we're not at a standstill, but things have slowed down a little bit for us because our first concern is our seniors. But guys, if you look back to 2008 on senior living, when all other forms or most forms of commercial real estate collapsed, senior living actually held up very well. Rent rates continue to grow because most people, if you've dealt with a senior that has, memory care issues or needs assistance, most families can't take care of that loved one at home. And so, they'll stop going on vacation. They'll stop buying, Mercedes-Benz before they pull mom or dad out of a memory care room. So again, senior living does tend to be more defensive. This particular recession is a little bit more risky for us, obviously, because of the nature of the virus. But again, right now we're still growing. The doors are locked. We're on lockdown, but we're still taking residents.
So, have you thought about doing the virtual, kind of video tours and set those up at all?
It's a great idea. We are doing virtual tours, absolutely. So we're doing them in Venice. We're doing in Palm Coast. Our Delray Beach community opens up in May, so we don't have the ability to do that yet. But we do have, I think, 10, maybe 12 pre-reservations for that community. So it's a great idea, and it's one of the things we do. Operate our own communities in house, and so Kieran, who runs our social media and online, was very quick to develop that for us. It's a great idea, though.
Oh, one thing I have to think about here is because they are senior living, we have a lot of people that are technologically inept
right
group. So you would have to send that to a son or daughter to get that.
Yeah. Well, I'll tell you though, Bill, keep in mind though, the person that typically makes the decision for mom or dad to go into senior living is the adult daughter.
Yeah.
So that typically is a little bit more savvy, technology wise individual.
All right. Excellent. By the way, audience, don't forget, if you have any questions for our panelists, put a question over there in the chat box. Jonathan?
Yeah. Next question is, I think, Jacob, you kind of touched on this. What were good deals before maybe aren't good.
Jonathan, before you ask the question, sorry to interrupt, but your mic is very, very low, and it's very difficult for anyone to hear you. So not sure what the answer to that is.
We'll get Jonathan to talk louder.
How's this?
That's good. So make sure you point it at Bill when it's his turn to talk, because it sounds like he's whispering.
Gotcha. Okay. All right.
All right. So hang on. Just have a couple seconds of silence. The line will disappear, and then you can, and I'll disappear, and you can start.
All right, guys. Next question. As Jacob said earlier, what was a good deal before maybe not is a good deal now. So kind of leads into the question is, what are you all looking at to determine what is a good deal right now in this current climate, this current market? Glenn, can I get you on this one first?
Sure. Yeah. I mean, we're looking for cash flow, number one. So that's now we are testing the market. What we're doing is we're lowering our offer prices like about 10-15% right now. Testing. Now we really haven't seen a decline in prices yet. We think we will. We think that, probably in the next 3 to 6 months, we'll start seeing the market come down a little bit. But once again, our asset class, what we do, it's all about the cash flow. And so if we can hit our numbers on cash flow, we're still buying the properties. But we are putting in lower offers because we obviously want to catch them as they're coming down too. So that's what we're doing.
Okay, great. All right. Fernando?
Yeah, so we're a very cash flow focused business. That doesn't mean that we don't do development, but it's a 10-to-1 ratio. So for every 10 cash flowing assets we buy, we'll do one development deal. So on the cash flow side, these existing facilities, we are buying based off of T12 income. And regardless of what type of value add potential there is in the deal, we are buying to make sure that we're hitting a 1.25 at the minimum, but we're more likely falling in the 1.5 to 1.75 debt service coverage ratios day one. We are, like Glenn said, making some pretty aggressive offers, and the way that we do it is two-tiered. So we have two different companies. One company comes in and makes a super low aggressive offer to see if there's anywhere that we can get to. And in case the relationship is soured slightly, then we have the second company that can come in with a second acquisition manager to come in and start fresh. And now we know where the floor is from the seller's perspective. On the development side, we are no longer doing any deals that need to go through any type of zoning change or special use permits. The only type of self-storage development deals we're pursuing now are basically deals that are teed up already. They already have zoning in place. The cities are ready for it. And all we have to do is, raise the capital, do the syndication, close on the deal, and then start building.
Great. Thank you. Sean, what about you?
We've got letters of intent out on 2 communities, both on the east coast of Florida. So we're certainly looking for opportunities to acquire. What we really saw in senior living several years ago, that there were several multifamily groups that thought, hey, going from multifamily to senior living is a no-brainer. Let's start doing senior living, because they saw the demographics that were coming. And obviously, it takes a lot to operate these communities. You're running a restaurant, a multifamily, and a healthcare facility. So we're finding opportunities to acquire. On the development side, we're looking for properties. We know the markets we want to be in, and much like Fernando and several guys on the panel, we're lowballing offers for property. The unfortunate part about our side is you typically don't find properties on market, so they're a little bit tougher to find. So we need about 10 to 11 acres to develop these communities. But we're again looking for acquisitions and development sites right now.
Great. Chris?
Yeah, deals I've been looking for lately has really been about predictability, like predictable cash flow, right? And anything to kind of keep that stream of income coming in, But I mean, that's the thing is like I see there's deals today. I mean, there's properties I'm putting offers on now. There's even deals I see coming in the future. So I'm playing a balance of offense and defense, where still looking for deals now, but I'm also just like what Shauna just mentioned, like looking for acquisitions later too. Look for those opportunities where, there's gonna be a bunch of crap hitting the fan for some people, and I think that's some of the best buying opportunities. And that may not be as much of a cash flow focus as it is growth, but I think there's still that balance. And so staying liquid a little bit while still getting the money working and creating that predictable, stable cash flow, because I think that's where the winners will be.
Yeah, agreed. Jacob?
Yeah, we are for the time being in the self-storage business, we are paused on any ground-up development deals or any C of O acquisitions. Our last vacant deal that we bought was in November of last year. That one's going fine, but as Chris mentioned, we're hyper-focused on predictability. And a ground-up development deal or a vacant self-storage facility, it's hard to predict revenue streams right now because it's so day by day. Historic data almost doesn't matter given how fast this has all happened. So the good deals we like right now are deals with good occupancy, good in-place revenue, good in-place NOI, where we have the opportunity to grow NOI and grow revenue, but if we don't, the deal still stands on its own. Deals that we're kind of shying away from, in addition to ground-up development or C of O acquisitions, are deals with a big lease-up component. We bought a few deals last year that were maybe 55, 60% square footage occupancy, and we're shying away from those now unless we can just steal them at a really low price per pound. And again, just really focused on predictable revenue streams on a facility level and also an aggregate across our portfolio. And for the time being, until we see a good reason to, we're staying away from any ground-up development deals.
Well, I mean, that's a smart thing to do in this market with anything that you're into right now. We lend on fix and flip stuff, but we also did ground up construction, and we've completely stopped that.
Yeah.
We're not doing any rehabs that are going to be more than 50% of the total value. So we're really sticking with what can be taken care of quickly, because the biggest thing you worry about is time on market. The longer it takes to market, I mean, stuff is changing so quickly. It's hard to keep up with it. We want it to be able to get in and out, and you don't know how the municipalities are going to be with permits and zoning, and it's just easier just to do the lipstick on a pig and move it on, right? So we're all trying to stay a little light in that area. All right, so I know I went through 08. Most of you guys did too. What are some of the takeaways from the housing and credit debacle starting in 2007 that you guys think can apply today? And I'm going to start with Jacob on this because he looks old.
Yeah, that's a good question. My knee jerk, honestly, is I don't know if a lot of it applies today. This is so universal and so sudden. I mean, the 2008 fallout, which I went through, and I'm sure a lot of the guys on this call went through. I was doing fix and flips back then. I was a full-time firefighter, and I quit my fire job to do single-family homes and got beat up, but came out of it and made a business out of it, and I'm glad I did it. But you could really attribute that fallout to just bad lending practices, people being over-levered, people getting access to credit who shouldn't be getting access to credit. And it hurt our economy quite a bit, but people were still going out to eat, and people were still going out shopping and going to bars and still traveling. So I really don't know what I can apply from that lesson to this, just because of how this manifested itself. We're specifically trying to remain liquid. We're trying to be responsible with our leverage assumptions to make sure that we're not levering a deal beyond what might be irresponsible during what is very likely a pretty significant downturn. But my big takeaways from back then are just underwrite deals conservatively, execute on your business plan, have a downside scenario that you can believe in, that you believe you can get through if it actually happens, and just execution and be conservative. There are definitely some parallels between the 2008 recession to today, but this just feels so different and so much more universal and so much more sudden. For me, mentally, it's really hard to draw parallels.
Yeah, you hit on a good point. Leverage. I mean, leverage both giveth and taketh away, and it seems like we all have to be reminded of that every 7 to 10 years.
Yeah, no, there's good leverage and there's bad leverage. I know it's not a debt if it's bringing you an asset that's bringing you income. It's only a debt if you're using it to buy stuff you want.
They're depreciating, yeah.
And most of the people that got slammed last time were the people that were over leveraged, and they weren't concentrating on the cash flow. They were thinking more of my tenant will pay for this while the value goes up, because the values never go down; they're always going to go up. So that really hurt them.
They weren't focused on the cash flow, which I think every person here has said.
Yeah. Yeah. John, what about you? Any takeaways?
I think, guys, 2008 was different because the banks, because of all the mortgage problems, did not have cash. I mean, it's different today because the Fed has just pumped these banks full of cash. It's reduced the regulations on loaning, and a lot of banks are, increasing their standards again. But I think it's a little bit different from that perspective. One of the things I'd also mentioned to you that, as Chris mentioned, cash is king, and one of the things we're focused on, at least for this year, is refinancing the debt on our Venice community. So obviously, if you can create more cash flow, potentially use this economy as a positive. Again, the lending channels may not be open, but we've actually already notified HUD that we intend to do a long-term refi later in the year. So, again, we all know that, hey, this is a tough economy. It's a rough time for us all, but I think there's going to be a lot of opportunity that comes from it. And another thing that we're trying to do right now, which we really didn't do in 2008 because we hadn't developed at that point, but just getting out and putting out the word to investors. I mean, we're all, everybody on this panel develops alternative real estate investments for investors that focus on cash flow. We're doing great work. And so getting the word out there to investors is also very important. But, this, as Jacob had mentioned, this economy, it just collapsed. I mean, it absolutely fell off a cliff, and that was a little bit different because you started to see, the 2008 recession coming in 2007, and it was more elongated. But this one was just a real flash, a real lightning bolt. So some differences, but also, for us, maybe some opportunities as well.
Glenn, I know you're in the business that you're in now because of 2008. You changed your model. What takeaways do you have?
Yeah, absolutely. And the first thing that comes to my mind is that, having private money versus bank financing, because a lot of the capital markets are froze right now. There's a lot of people sitting there trying to reassess values and assets and so forth. And, we have a lot of private investors, and they're educated. They understand about the cash flow. So that's not holding us up. So, we look at it this way, and that's why we love the rental business too, because no matter how much the banks freeze up, there's two things people are going to do. They're going to eat first, have a roof over their head. Number two, we have the most affordable roofs, so we feel really, really good about that. And, case in point, our leasing department, they're covered up right now. They're swamped. I mean, way more people. We're getting way more applications right now than we were before that, because I think there's going to be a real need for affordable housing. That's what I think. But, if I had the private money back in 2008 that I had now, I would have done substantially better, and there's going to be real opportunity here. In the next, like I say, the next 3-6 months, next couple of years, I think there's going to be some great opportunity out there for those that have the capital behind them and are ready for it.
Thank you, Glenn. Chris, you were not the anti-financial planner. Or what do you call it? What-
Anti-financial advisor.
Yeah, there you go, advisor. In 08, you did.
I was. It was 2000 that I wasn't. The Y2K is when I was the traditional advisor, right? And then I switched after that. So I know I look so young, you know. I'll tell you. Here's the thing that I'm seeing. I mean, really the one thing we see in common is that it's a recession. You know, like there's always these ebb and flows. You know, and there's smart money and there's dumb money. You know, there's opportunity and there's going to be loss. I mean, that's the thing that I think we can always count on. And I'll echo everything you guys all said too, because you know, going for cash flow is key, and having cash stored up, right? And looking for those opportunities, and really you're going to win, especially if you've learned from it. I mean, I've got half the hair I had from 2008 right now, you know, like, you know, I'm looking forward to getting that hair back after this next recession, you know, may have to go to a depression to get that hair back, you know? But here's what I'll tell you, like finding where there's going to be losses, what makes this different, right? Is, you know, I remember Y2K, and if you ever want to see where there's going to be massive losses, you know, there's always a bubble that goes with every recession, right? And so Y2K, the bubble is because people were throwing money into tech companies when there should have been money going in. You know, last recession, 2008, for example, I mean, we had money being thrown into money into people's hands that just had a heartbeat. You didn't even have to claim income, you know, and money's been thrown in their hands. Appraisals were being, you know, fraudulent and everything else. And so real estate was that bubble, right? This time around, it's a different bubble. Like people keep looking back to last recession thinking it's going to be another real estate bubble, but it wasn't. Like there was already so many things put in place. It prevented a bubble from happening in real estate. So if anything, if you're looking for safe harbors, real estate, I believe, is one of the safest places you could be, you know? If there is a bubble in real estate, it might be in the multifamily sector with some of the people that jumped in that had no business being in. And I think that's where a lot of you guys are looking for opportunities, just like was mentioned earlier about, you know, the assisted living, right? Some people just want to, you know, go into that and don't know how to manage it. So looking for those bad operators will be the opportunity right now. But I'll tell you, the bad part, the bubble I see is actually with corporate America, because even before this was hitting the fan with the virus, there were guys out there, there was bond managers out there saying, I have junk bonds. Like we've been throwing money into bonds and it's a lot of this is junk. Like this is like 1987 all over again. We're buying crappy bonds in companies. And so I think, especially with this virus being such an accelerant, right, compared to these other gradual recessions, is that you're going to see a lot of companies start to blow up, and even the bond market is going to start crashing. And that's the place where people think is safe right now, right? But I mean, stocks and bonds are going to be the crash. You're going to see that as being like the bubble this time around. Where real estate, where it's just where people are scared to be in, is actually the opportunity. And so always look for where people are scared to death of, because that's probably where the opportunity is right now. And where everybody, even the dumb money's going, where people that have no business doing investing say, hey, I think you should put more money in the market. That's exactly where you should not put your money. Is almost do the opposite of where the crowds are running, run the opposite direction. You'll probably be the one that actually creates multi-million dollars from this next recession.
Excellent advice. I see in some larger markets, there's an overabundance of Class A multi-family, and I think that's going to take a bit of a hit, because I see we're going to have a lot more savers now, and people are not being willing to spend money on the luxury items right away.
I agree.
The people that do have the money are going to feel bad about the people that don't. Because I remember this during the last recession. A buddy of mine had a audio video company that installed home theater systems, and he was booming right up until then. But then the really high net worth people didn't want other people seeing that they were getting a new home theater installed. They'd rather have them get something installed that would save the planet, because they didn't want to show off their extra wealth. So, Fernando,
Yes.
Do you see any parallels?
Yeah, so I was actually graduating high school in 2009, so I wasn't investing at that time. But
read about any of that stuff.
But so here's the thing. So I actually did start reading Rich Dad Poor Dad when I was 16 years old, and I did see, as things were happening, as if I had invested my own money. Now, I would like to kind of echo some of the things that Chris said, where I think in 07 to 09, these large Fortune 1000 companies, what they learned in that period is that they can over leverage, they can be extremely risky, and then they can use their extra cash to buy back stocks to pump up the price. And then if it doesn't work out, the taxpayers are going to bail them out, right? And now look what's happening. Now we're here again. It's 2020, and that what they were betting on has happened again. And they're getting paid off for that. All these big companies, they took massive risks. They over levered themselves. All they cared about was the end of this quarter's results to pump up their stocks. And if their stocks dropped for whatever reason, they used all of their available cash to buy back those stocks. Now you have the majority of the U.S. economy shut down. A lot of these people that bought these stocks in their 401ks are getting slammed. Yet the CEOs and the boards of these companies, they're not taking any pay cuts, right? They're walking away with fat checks, and they don't care because they learned from the government from 07 and 09 that the taxpayers are going to bail them out. They get to keep all the profit, and if there's any losses, that will be borne on the taxpayer's dollar.
Yeah, a lot of if you look at the airlines, they were flush with cash and they were buying their own stock. They would have plenty of cash to go through this. Now, again, it's not their fault that no one's traveling. At the same time, this is the kind of stuff that happens. You thin the herd, and we're now picking and choosing winners in certain markets, and that's not a good thing. I think we're going to end up with a lot of deflation or inflation in certain areas, and real estate's the best place to be in during that period because it's a solid asset. Right?
Yeah, absolutely.
Right, you're up, bud.
All right. The last question, guys. It kind of seems over the past few years, anyone could, from the lending side anyway, and maybe from the investment side as well, you all can speak to this. You could just get into the deal, and it worked out. It was great. Not a whole lot of people were using data to incorporate in their decisions. So I guess my question to you guys would be, what critical data do you all currently use, or is there new data or new data points that you're going to use moving forward because of what's happening? Let me start with Sean.
That with our communities in general, I mean, we have obviously used outside data sources, but we've actually also we have an entire accounting department at the corporate level, and have developed packages that can tell us, hey, if a community is underperforming, why is it underperforming? And we can actually dial it down to the type of room that's underperforming. So, we've actually created a lot of things on our own. As far as like market data, there's a lot of great stuff out there. The National Investment Center for Seniors Housing is really kind of the big thought pool, has annual conferences, brings a lot of great information. A lot of the big builders, the big CB Richard Ellis, those kind of companies have a lot of great information as well. But the one thing about senior living is the first baby boomer doesn't turn 75 until this year. So the market data itself, the demographic shift we're going through, we've known about this for the last 5 to 10 years. But we're certainly doing a lot with technology to make sure that on our corporate level, the local communities are synergistic with our goals and our culture, on the Orlando side. So,
Great, thank you, Jacob. Is there anything that you're currently using, or anything that you are going to employ moving forward?
Our data analysis is about the same as it was. We typically look at supply ratios in the 1, 3, and 5 mile trade radius. We look at median household incomes, population density. Historic data right now is so recent; it's hard to get to it very much. You can look at stuff from a couple months ago, but a few months ago don't matter like they do right now. So we're mainly focused just on the submarket supply ratios, household income, rental rates. We try to be the low cost provider typically. So we'll analyze competitor rates and make sure we're at or below those rates. But we're looking forward to seeing the data from this downturn start to mature and start to really be able to infer what's happening in our various asset classes that we touch. Because right now we're seeing more seller leads and we're seeing a little more distress and motivation, but we're not really seeing a reduction in values yet. We know that's coming. But the recency of the data is what we're really focused on, and that's just not out yet.
Yeah. Okay. Fernando, can you get your take on this as well?
Yeah, so we've actually increased our spending on data over the last 30 days. We brought in Audantic. We've been closely working with the CB Richard Ellis's of the world, Yardie Matrix. For us, it's not only the data, but then also hearing what's going on from other investors, right? So that's why these types of calls are so important. You know, I'm jumping onto Collective Genius weekly calls every Friday and staying on that call for 2.5 hours, seeing what everybody else is seeing across the country, because there are kind of waves that move across the country and we can kind of time ourselves. As far as what we're looking for in data, we're spending a lot of money on the seller side, right? We're trying to find those sellers that are looking to get liquid. We're trying to go in and close fast, usually either with cash or with some quick financing. And then on the management side, we're really relying on our managers to keep their ear to the ground and talk to the tenants. And we're having our managers call tenants daily to see what's going on in their life. You know, don't make the call about paying the rent. Make the call about how are you doing? What is there anything that we can help you with? What are you seeing? You know, what industry are you in? And then making sure that we're taking notes and bringing them back to our level 10s on Tuesdays and making sure the rest of the company is hearing that.
Yeah, great, thank you. Glenn, what about you? Are you employing anything new, or you have it all figured out?
No, I still don't have it all figured out. But just like Fernando said, I'm on that CG call for 2.5 hours every week. There's another group I'm on their call too, keeping up with the trends around the country, because usually it starts on both coasts and then it comes to the middle of the country. So that's one great way to stay on top of it. And really, for our asset class, what we do, just watching MLS, we'll be able to feel it when the prices start coming down. They haven't yet. We suspect they will, but that's why I think we just have to keep, offering a little bit lower to stay on top of stuff. But really, I think, yeah, MLS realtors, we talk to a lot of realtors. We just keep our ear to the ground, and that's really what we're doing.
Yeah, it seems to be the case that the best data is your network.
Yeah, and I would like to dovetail on that. And we've talked about Collective Genius a few times, a few of these shows as well. For those who don't know, Collective Genius is a mastermind group of investors from all over the country. They're all top-notch investors. They've been there, they've done that, they have proven track record. And it's like your board of directors. You really have to have a good group surrounding you if you're in business with yourself. It doesn't matter what level. You need to have people that will give you honest answers, will tell you your idea is stupid and why. And because as entrepreneurs, we have all these great ideas that come out of us, and probably only a third of those ideas are worthy.
If that high, yeah.
And what it does, it helps keep you from just going all over the place and chasing after shiny objects. The other thing, being involved in a mastermind group or a networking group, is that it's an insurance policy. You can see what's going on in different areas of the country, different business segments, and be able to ascertain what may happen, or at least give you a good heads up on what's coming your way, and give you a way to be proactive instead of reactive to the market. Because you have friends, and they are friends. When we get together, it's like a big family reunion. By the way, you've got something on me. And they really give you good, honest opinions. So that said, listen, guys, I appreciate you being on the show. You had some great information. I know
Thank you,
our
guys.
audience got great information out of that. Don't forget to subscribe and share. Our contact is carolinahardmoney.com. You can still leave questions on the chat if you want, and we'll get to those later because the show is ending now. Anyway, you guys have a great day. We'll see you next week at the same time.
Yeah.
Take it easy, guys.
Take it easy. Y'all have a good one.